Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. And now over to you, Alex. What questions do you have today from our listeners?
Thanks a lot, John. I appreciate that. And Jim, the entire time you were talking about the gold on the Fed balance sheet, I couldn't help but smiling because I was thinking back to this episode where Ron Paul was questioning Ben Bernanke about the role of gold, and Ben basically saying the reason we hold it is just out of tradition. I thought that entire thing was pretty funny.
Right. I've testified before Congress a few times, and if you have an investigatory subcommittee, and I did that once, you're under oath. You have to, raise your right hand and take an oath. But I don't think Ben Bernanke was under oath in that particular exchange.
Very good. Okay, so we've got a lot of different questions coming in from different parts of the world. Some of these are obviously non-U.S. A couple of quick items. One is we're getting questions about the special edition of the book. That special edition is being produced by Physical Gold Fund in combination with Penguin. It's going to have a chapter, or part of it is going to be written by myself, and also there's a special part of it that's written by Jim doesn't exist in any other version of the book. These will be available sometime after the standard edition is published. If you want more information about it, what I recommend is go to the physicalgoldfund.com website, and there's a place where you can put an email in to subscribe for more information. If you've registered for this webinar, you're already going to be on our mailing list. But if there's anybody else that you know of that might be interested in that, they can go there and put their information in. So a question that's coming from Amer A. Jim. He's asking about the book audio version. He's saying, how can I purchase the audio version? I drive a lot and would love to listen to it.
Well, thank you for that question. And there will be an audio version. It might not be up on Amazon yet, but it will be on the pub date. And the reason I know that is because I actually recorded the audio version. This is my third book. I had Currency Wars in 2011 and The Death of Money in 2014. And I'm very happy to say that both books continue to sell very well. They're timely. The currency wars are not over, and threats to the international monetary system are not over. So those books are still selling well. But I did not read the audio versions of those. Long story. My publisher sold them to a producer. I understand the people who did read them were great voice actors, and they have their own fans and their own following. So I think they were good audiobooks, but I didn't read them. But like the caller, Alex, I drive a lot. I listen to audiobooks a lot, and I always like the ones read by the author. I just think there's no one but the author who can give it just the right nuance in the right places, because he or she is the person who read it. So I was happy to see with the new Gold book, my publisher said they were going to produce the book themselves in-house and not sell the rights to another production company. And I immediately raised my hand. I said, well, I'd love to read it. And they said, oh, you really don't want to do that, do you? You got to sit in the studio for days. I said, no, I would love to do it. I did. It was an interesting experience. Literally 2 days in the studio with earphones on, reading the book. I had a world-class voice director. This guy was great guy. We got along great, but he was sort of the Stanley Kubrick of voice directors. The standard was perfection. This guy was so tough on me, and the number of times we had to do things over, and he was always friendly, never got acrimonious, but he would say, Jim, I'm not hearing the D in connected, connected. So I just had to enunciate my consonants a little more clearly. So it was kind of, like I say, an interesting experience. I try to talk in a relaxed way, but this was holding my feet to the fire. But we got through it, and that's being edited as we speak. It'll be an unabridged version, so nothing's being cut out. They're just, other than my mistakes, but we did them all over. So there will be an audiobook. It will be available on Amazon. It will be read by the author. I don't think they put those out for pre-sale because it's like an instantaneous download, and so there's really no point in doing that. But it'll be up on the Amazon site soon under the new Case for Gold check back. But yes, there will be an audiobook, and I read it myself.
Excellent. I'm looking forward to that one as well. Okay, very good. So we have a question here that is coming in from HBK Bangalore, and the question is, what will be the impact of decisions of central bank of Western world such as Bank of Japan, ECB, Fed, on gold prices in emerging market currencies like India, Russia, countries that are net importers of gold?
Well, the sure-run impact is that the gold price is going to go up, and the reason in those local currencies, of course, I expect it to go up significantly in all currencies in the fullness of time, but on any given day, I think of gold as money. I do not think of gold as a commodity. I don't even think of it as an investment in the classic sense. I think of it as money, but I say, well, if you want money, you should have some gold because of the vulnerabilities of other forms of wealth that we talked about earlier. But what's happening right now, I said that the Fed is not going to raise interest rates this week, and they're not. But that ease is already priced in. In other words, this was something that was signaled partly through Fed inaction as early as late January, certainly increasingly through the month of February. So if you originally thought they were going to raise, which everybody did, and then you come to the conclusion that they're not going to raise, which is the conclusion, that actually represents a form of ease in terms of expectations. If you have expectations for hike and they don't hike, that's a form of... So that has accounted for the stock market rally since February 12th. So the rally we saw even through Friday, which is pretty significant from the February 11th lows, was all based on this idea that the Fed was not going to raise rates. The problem is we already got our pop. We got our market benefit out of this. So again, the Fed's not going to raise, but the benefit on Wednesday, but the benefit of that is already priced in. So now the market's saying, okay, what's next? And what else have we got for us, Fed? Well, I think what the Fed's going to say is, well, what we've got for you is a rate hike. We're going to hike in June, and that's going to, at the margin, obviously be a form of tightening and make the dollar a little bit stronger. Now, the ECB also tightened. When I say tighten, I should be clear what I mean. It's tightening relative to alternatives and relative to expectations. Now, the ECB on March 10th last week actually lowered their interest rates. They're already into negative territory. They went further into negative territory. I think they're now about negative 40 basis points. So well, that's a form of easing. Well, it is, except that Draghi in the same breath came out and said, we think that's as far as we're prepared to go. In other words, he was signaling that they're not going to take interest rates lower. So if markets had priced in lower rates and Draghi's saying they're not going to take them lower, that's a form of tightening relative to expectations. And indeed, the euro rallied on that news. On the Bank of Japan, the same thing. There was some expectation they would get out the bazooka, and they didn't. They did nothing. But so now all three major central banks, U.S., Japan, and Europe, ECB, are in a tightening frame relative to alternative courses relative to expectations. That's going to make all these developed economy currencies a little bit stronger relative to emerging markets currencies. So it looks like a risk off in terms of the emerging markets. And what that means is your price of gold in your currency goes up faster than the price of gold in dollars, euros, or yen. So if I were sitting in Bangladesh or India or Malaysia, those currencies have, by the way, those currencies have strengthened recently based on all the disease coming out of Japan, U.S., and Europe. But it looks like literally as of the last few days and as of tomorrow, that easing is over. It's now into tightening mode. That's into risk-off mode, which is going to weaken the emerging market currencies and make the price of gold go up higher in your currency than it will in dollars.
This next question, Jim, is coming in from Dale H., and it's a question that I personally find really interesting. And his question is, why isn't Japan concerned about obtaining gold to the same degree as China? And I would add to that, why is, for example, Japan, Canada, and UK different than, say, China and Russia accumulating?
Economically, they're not different, so the question is, why have they dumped gold? Now, Japan has about 600 tons. It's a little bit low relative to their GDP. Actually, it is significantly low relative to their GDP, but it's not nothing. The UK has completely inadequate gold. The guys who are completely unprepared, who have gold relative to GDP that you can't find under a microscope, are Australia, Canada, and a few others. And even those who still retain significant gold, they've sold a lot. Switzerland's a good example. Switzerland still has over 1,000 tons, but they've sold over 1,000 tons in the last several years. So the question is, if Russia and China are acquiring gold, if the U.S. is sitting tight, keeping the gold it's got, why are some of these countries selling gold? And I think the answer is that, A, they don't understand what I've been describing on this call and in my book, The New Case for Gold, and elsewhere, is that we are still on a shadow gold standard. If confidence in paper money is maintained forever, then you don't need gold. But the history of fiat money is that confidence is not maintained. There are panics from time to time. The international monetary system has collapsed 3 times in the past 100 years. it will collapse again. When it does, probably sooner than later, you're going to need to take steps to restore confidence. Now, I'm not saying that there will automatically be a gold standard. There could be. But even if gold is used as a reference point, or even if it's just a matter of the major economic powers sitting down around a table and rewriting what they call the rules of the game, in other words, reforming the international monetary system, think of it as a poker game. You know, when you sit down at a poker game and you want a big pile of chips, well, in the scenario I described, your chips are going to be gold. And as the gold powers are going to decide the future of the system, as happened at Bretton Woods, and the gold weaklings are going to be sitting not at the table but against the wall and not have very much to say. So if you're the UK, Australia, Canada, even Japan to some extent, you're just going to tag along with the U.S. You're just going to accept whatever deal the U.S. cuts because you don't have enough gold to stand up for yourself. Conversely, countries like Russia and China are going to have a very big voice because they're going to be in a position to say, you know what, if we don't like the deal the U.S. is proposing or that the IMF is proposing, we'll just go our own way, start our own currency, use gold to restore confidence, set the price of gold at, you know, what would be maybe 500% higher than what it is now. That's where this $10,000 figure comes from, and start the game over on our own. And if you have enough gold, you can do that. So gold are going to be your chips in the poker game. The gold powers are going to dictate the future of the international monetary system. Whether it's a gold standard or not remains to be seen. It might be an SDR standard, that's IMF World Money, special drawing rights. It might be a hybrid. It might even be a gold-backed SDR, which actually makes a certain amount of sense. The one thing I can guarantee is that any reference to gold will be at prices of $10,000 per ounce or higher. And the reason I say that is because any lower price is deflationary. In other words, any gold standard, it doesn't matter how you design it, is some relationship between gold and paper money. That's all it is. You say, okay, well, what's the dollar price of gold in the standard? How much paper money do I have? How much gold do I have? How much trade and commerce do I have? And what does the price have to be non-deflationary? Now, the problem is, right now at the market is $1,200 approximately, a little higher than that, but we're not on a gold standard. So gold can be wherever the market wants to take it, taking into account manipulation and other factors. But if you were going to have a gold standard and you did not want to cut the money supply by 80%, which is comparable to what happened to the UK in 1925, you'd have to set the price of gold high enough so that the amount of gold you had could support enough money to run the financial system. And this is one of the canards I talk about in the book. And by the way, Alex, I not only have all the arguments for gold, but I list the arguments against gold, and I knocked them down one by one. It was kind of like taking a bowling ball and sending it right down the middle of the alley and knocking down the 10 pins. So I hope the readers enjoy that part of it also. But just to give an example of what I'm talking about, when the gold bashers come out, or you're on TV or you're in a debate or at a cocktail party, whatever, and you say something about gold, somebody will say, well, you can't have a gold standard because there's not enough gold to support world finance. That's nonsense. I mean, there's always enough gold. It's just a question of price. Now, at $1,200 an ounce, no, that would be extremely deflationary. But at $10,000 an ounce, it works just fine. When I talk about $10,000 gold, it's not a made-up number. It's not a number I pull out of a hat to get some attention. It's actually the result of a calculation using gold to money ratios without having to destroy the money supply. So there's always enough gold at the right price, and that would be one way to reform the international monetary system. But the gold weaklings, as I call them, are just not going to have a voice in that.
Okay, that's a very interesting answer. The thing that you said about any price for gold under $10,000 an ounce is deflationary in any kind of a gold-backed system. I mean, that number, that's a pretty big number, I think a lot of people would say. I'm reminded of the other day I was watching a wealth manager for JP Morgan. I think it was on CNBC, and he was almost insulted, I guess would be the way I would describe it, that gold was even $1,200 an ounce, as if there's this kind of resistance to the idea that gold should not be higher than a certain amount. I think a lot of people are going to be shocked if it gets out of that range.
I won't be shocked because, as I said, we've talked about it a long time. But, actually, if you go to my second book, The Death of Money, I think it's chapter 9 or chapter 11, but one of the chapters toward the end of the book where I talk about gold, there's a quote from Paul Volcker. Again, I'd like to emphasize the fact that when I talk about these scenarios of, cyber warfare and stock exchanges being closed and the price of gold going up and deflation and inflation, they've all happened. They have all happened. They're all documented. But the quote I found from Paul Volcker was, he said exactly what I just said. He said, you don't have to have a gold standard, but if you do, the price of gold would have to be, he just kind of rolled his eyes and used some, not to say expletives, but I won't repeat his exact words, but he said it would have to go to the moon. It would have to be sky high for that system to work. And he's right. So I quoted him, but again, I did the math myself just to put a finer point on it. But by the way, $10,000 is the low end of the range. That assumes that you want to back up M1, that's one measure of money supply, with 40% gold. If you wanted to back up M2 with 100% gold, which is another way to do it, that price is $45,000 an ounce.
Interesting. Okay, very good. All right, so to get into some other questions we have here, Jim, this one's coming in from Arthur S., and he's talking about the equity markets. His question is, if the S&P falls to, say, 1,300, 1,400, what do you expect the response is going to be from the Fed, and will it have any kind of an effect long term?
Well, at that level, assuming it's precipitous, which I assume is what the question implies, they would, first of all, obviously not raise rates. One of the questions I asked myself in thinking about the Fed's rate hiking paths is, what would it take for the Fed not to raise rates? And that's one of the scenarios. I don't think it would even have to go that low. I think S&P at 1650, if it dropped from, I'm not sure where it is right this minute, but assume it's around 1900 or so, down to 1650 in a matter of, a few weeks, that would be enough to put the Fed on hold. Beyond that, what would the Fed do? If it continued to fall, or if we were clearly in a recession? When I say clearly, I think we're going into a recession based on the data I see, but if it were so clear that even the Fed saw it, they would, the first thing is not hike rates. Second thing would be to cut rates. One thing about, I said that they wanted to get them up to 300 basis points, cut them 300 basis points, but they may get to 75 or 100 basis points, and when the recession hits, in which case they would cut 75 or 100 basis points, get back down to zero. And we've heard this a lot. I know Arkash in New York Stock Exchange, a lot of people see him on television. He said they will get to zero before they get to 1%, meaning they would have to turn around and cut and go back down to zero before they ever got far enough along. I think that's probably right. At least it's a pretty good estimate. And then beyond that, so first you stop hiking, then you cut. What else could they do? Well, they could use forward guidance, which would basically say, well, not only are we raising, not only are we at zero, but we're going to stay there for a considerable period. Pick your adjectives, pick your phrase, and we're going to be patient. Remember all these famous buzzwords from just take the period of forward guidance from about 2010 to 2015 when they finally ended it. They had, extended period, considerable period, patient, you name it. They could get the thesaurus out and come up with some new phrases, but that would be next. It's the toolkit. Currency wars, QE4, negative interest rates. There are a lot of things they could do, but they'll certainly be easing heavily if the stock market falls that much.
So we are getting close to the end of our time, and we have a ton of questions left, so we're going to try and lightning round a couple of these. This one particular question is coming in from multiple people. Vince W. is one of them. Michael K. is one of them. I'm going to kind of paraphrase it because they asked it in a slightly different way. But the question essentially is, what do you think the likelihood is of some kind of massive windfall profit tax on gold? And is this a likely event? What can anybody do to mitigate such a risk? Should you still buy gold? These are all the kinds of the questions that are coming in regards to that.
Well, I'm certainly not going to give tax advice, but I would say the thing about a windfall profits tax is that it would have to be an act of Congress. I don't think the president's not shy about using executive orders and emergency powers. When gold was confiscated by FDR, Franklin Delano Roosevelt, in 1933, that was an executive order. That was not an act of Congress. Later on, Congress did pass a law that ratified what the president did after the fact, but the day he did it, it was an executive order. And you say, gee, what was President Roosevelt's statutory authority for giving an executive order confiscating all the gold in America and making it a felony to own gold? Well, it was the Trading with the Enemy Act of 1917, which is interesting because the Trading with the Enemy Act of 1917 was enacted during World War I, so the United States could seize German assets in the United States, which we did. That's how we got Bayer aspirin. Bayer AG Aktiengesellschaft was actually a major German chemical and pharmaceutical company, and we seized their U.S. affiliate in World War I. That's what we call Bayer aspirin today under the Trading with the Enemy Act. I'm not sure who the enemy was in 1933. It must have been the American people, but that was, FDR never let a statute stand in the way of a good executive order. However, taxation is a step too far. The Constitution is crystal clear that tax bills have to originate not only in the Congress, but in the House of Representatives specifically. So what I would say to investors is I find it unlike, I've written about it. I think as an analyst, it's my job to point out all the risks, and that's not one you could rule out. And I don't rule it out, but I think that it's unlikely because it would have to be approved by Congress. And even if it somehow got through the Congress, you'd see it coming. The unlikely prospect of a windfall profit tax, which you could probably see coming, is not a reason not to own gold. I find, it's amazing, Alex. I'll talk to people about. I remember talking to people about gold when it was $700, and not that long ago, by the way. Say, you really ought to have a little gold in your portfolio, 10% or whatever. And the person would listen to you and say, that you're right. I should do that. Then you'd see them 6 months later and say, did you get the gold? And they go, oh no. And then 6 months after that, did you get the gold? No. Even people who are intrigued by it, people who are persuaded by the argument, people who see the benefit of having gold in your portfolio, don't actually go out and get any. And just to take it a step further, what they do is they look for excuses not to get it. People are lazy, basically. They hate to do anything. There's a lot of behavioral science to back that up. So what you happen is you run into these people, and I'm not saying the question is one of them, by the way, but I'm just using this as a kind of a platform to make the point. You run into people who say, well, yeah, gold will go up a lot, but the government's just going to have a windfall profits tax. I'm not going to get the profits, so I'm not going to buy any gold. That is not a reason not to buy gold. Like I say, the profits tax is unlikely. Even if it did happen, you could see it coming. So in theory, there'd be plenty of time to, swap out of gold and get into land or fine art or some other hard asset. But I think the more likely outcome is that even if somebody thought that was a good idea, it wouldn't go anywhere. But it is certainly not a reason not to own gold.
Very good. That's a great answer. Okay, so I think we have time for just one quick more question. And for those of you who have been on this webinar and are asking questions, if you like this format where we're allowing more time for people to ask questions, we've been considering doing a full hour of just Q&A or something along those lines. So if you would be interested in something like that, please give us feedback, email us, or maybe message us on Twitter or something like that so we know what everybody would like to do in regards to that. So the last question of the day, Jim, is going to be, this is coming from Michael M. He wrote quite a bit here, but I'm just going to kind of summarize it down into a short question, and it comes down to how possible is a scenario where there is no major crash and we all may avoid pain and misery?
Well, first of all, it is possible, and I've never ruled it out. But then the question you have to ask yourself is, okay, it's not going to be mystical. What set of public policies would it take to help the economy grow, get out from under our debt burden, not through inflation or default, but through legitimate growth, with price stability, where the dollar value of gold would not change very much because we had a monetary anchor and a stable international financial system and price stability. So that's the happy outcome. What would it take? Well, the problem with the economy, and this has been true since 2008, probably longer, maybe going all the way back to 2001, is structural. We have structural problems. And everything the Fed has done is monetary. You cannot solve a structural problem with monetary solutions. That's why we still have lousy growth. That's why we have 50 million Americans on food stamps. That's why, despite job creation, we can't get wages up, we can't get aggregate demand up, etc. So what are structural solutions, and what would they be? Well, I would say, how about zero capital gains tax? How about a reduction in the income tax? Less regulation, more liberal labor laws. In Europe, you would look for labor mobility. In Japan, you would look for more inclusion of women, more liberal immigration. Let the Filipinos who now go to the Middle East go to Japan and take up a lot of jobs and help that economy overcome a demographic hurdle. So there are a long list of very positive things you could do to generate real growth. Then the next question is, okay, what's the likelihood of any of them? The answer is pretty close to zero. I don't see the political will, the political leadership, or the consensus to do any of these things. What I see is delay, denial, over-reliance on central bank voodoo and an unwillingness to confront the problem, which leads me to conclude that the system will collapse.
Okay, and with that rosy remark ending, I guess we're done. Jim, I really appreciate it. I always enjoy these conversations with you. And with that, I'm going to turn it back over to John.
Well, thank you, Alex, and thank you, Jim Rickards. It's always a pleasure and an education having you with us. And most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now. Look forward to joining you again soon. You've been listening to part 2 of the latest podcasts from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.